In this video, we're going to be looking at journalizing a business transaction, entering beginning balances into our ledger, and posting that transaction to our general ledger, including the post references for both our journal and our ledger account. It tells us that on October 3rd, 2018, Regal Company purchased $3,600 of supplies on account. In Regal's chart of accounts, the supplies account is number 15 and the accounts payable account is number 21. Remember, when we are preparing our chart of accounts, the first number in the account number indicates what type of an account it is. So all of our assets, for example, start with the number 1. All of our liabilities, 2, our equity accounts, 3, our revenue accounts, 4, and our expenses, 5. So they want us to journalize the October 3rd, 2018 transaction on page 91 of our Regal Company's 2-column journal, and it says we can include an explanation of our entry. So again, they're telling us that we're purchasing supplies and we're purchasing it, and there's that key phrase, on account. So on October 3rd, what we as the business are acquiring is an asset. We are getting more supplies. And again, supplies are something that we own until we use them. So supplies an asset, our asset is increasing, and we know that our assets increase with debits. So we're going to list that account first because again, with our rules of journalizing, we always list any account that's being debited first before listing any accounts that are going to be credited in the transaction. We have $3,600 debit to our supplies, and they told us that we purchased it on account, which means that we didn't pay cash at the time of the purchase. We're going to pay that money sometime in the future. So that means we have an increase to our accounts payable account, which is a liability. We're going to owe more money sometime in the future, and we increase a liability account with a credit. Now we have to go back to our directions and see what the next step is. It then tells us that they want us to prepare a 4-column account for supplies by entering a debit balance of $770 as of October 1st. They instruct us to place a check mark in the post reference column. We're placing a check mark because this is an opening balance. There's no page of our journal that we can reference for that value. They also want us to prepare a 4-column account for accounts payable and enter a credit balance of our $26,200 as of October 1st, again placing a check mark in the post-reference column because again this is an opening balance. Also, don't forget that they told us that our supplies account number is 15 and our accounts payable number is 21. So we go to our journal. The account is supplies. It's account number 15. It has a beginning balance as of October 1st. And again, they tell us here to put a check mark for the post reference because it's a beginning opening balance rather than referencing a certain page in our journal. So we'll go ahead and place that check mark in the post reference column. And because this is a beginning balance, we do not use these first 2 debit and credit columns. Those are to record when there's been a transaction that has affected that account. We're going to put it in our balance column. And again, they tell us that our balance in our supplies account is $770. The other account that's being affected in this transaction is accounts payable. It has an account number of 21. And again, it also has a beginning balance at the start of the October month. And we're going to include that check mark. Again, we don't use those first 2 debit and credit columns. And accounts payable, which is a liability to our business, normally has a credit balance because it increases with a credit. So now that we have set up our ledger for our 2 accounts, the directions tell us to post the October 3rd, 2018 transaction for the purchase of $3,600 in supplies. So if we go back to our journal, we look at the accounts and how they're affected. supplies was debited for $3,600 on October 3rd, and accounts payable was credited for $3,600 on October 3rd. So in our ledger, we do exactly what happened in our journal. So it tells us that our journal was page 91. So we post the reference that we can find this transaction on page 91 in our journal. On October 3rd, on page 91 in our journal, what happened to supplies was that it was debited for $3,600. Once we've posted the transaction, we now have to update our balance. So we had an existing balance of a debit of $770. The transaction also debited the supplies account. When they're the same, we add them together. So that tells us that our new balance in our supplies account is $4,370. For accounts payable, on October 3rd, again, the transaction happened on page 91. And what happened to accounts payable on October 3rd was that it was credited for $3,600, meaning that we owe $3,600 in the future for those supplies that we've purchased. Again, we have to update our balance. There was a credit of $26,200. This is a credit transaction. When we're the same, we add them together. So we now owe $29,800 in total. Remember, when we have the balance column, whatever side increases the account is the side that the account should have in terms of a balance. So for example, all of our assets should have debit balances, all of our liabilities should have credit balances. In terms of the balance column, we will only ever have one balance. So we're never going to have a balance on both the debit and the credit side. It's in either the debit column or the credit column. We now have to go to our journal and post that we have, in fact, updated the ledger accounts with these transactions. So in here, we reference the account numbers for our two accounts, 15 and 21.